If we look at current US-Israel-Iran conflict, well, it is changing faster than the Mumbai monsoon. US and Iran are in tough spot. This cartoon illustrates that in the best possible manner. Undoubtedly, closure of Hormuz Strait has impacted different countries in a different manner. Countries which depend upon imported oil energy like India, Japan, South Korea, Taiwan all got impacted. South Korea and Taiwan survived on the equity side because of companies like TSMC, Samsung, and SK Hynix, but their currency paid the price. Countries like US, China, which were not adversely impacted by Hormuz closure, they have by and large done well. The Hormuz Strait hasn't seen much traffic movement of late, and yet most fund managers believe that it will open sooner rather than later. Most people believe, almost half the fund managers believe Hormuz will open in month of June. The oil futures indicate prices to come below or around 80 handle by end of this year. However, what we need to constantly monitor that refining capacity has been hit thanks to attacks on oil and gas infrastructure in Middle East, and that will keep product prices higher. Higher oil prices invariably lead to recession globally. That's the experience of earlier crisis. Coming to global economy, Middle East and Trump has raised uncertainty, and global growth projections are coming down slowly but steadily. Central banks around the world has reduced their balance sheet, which had expanded during the COVID crisis. And central bank's balance sheet as a percentage of GDP is declining across most of the developed nation. On the other hand, global debt is increasing din doguni, raat chauguni, and this debt is borrowed maximum by the government 100 trillion, thereafter non-finance corporate, thereafter financial companies, and thereafter households. The central banks, despite worrying about inflation, have been cutting rates to support economy adversely impacted by Middle East crisis. But how long they can defer rate hikes? Inflation, while on headline is moderate, still below 3.5%. The future inflation trajectory looks on the higher side. Commodity prices like aluminium, zinc, copper, crude, including agriculture prices like wheat, rice, sugar, they are all moving up. In expectation of rising future inflation, the global bond yields are almost touching pandemic phase inflation. Inflation continues to hook fund managers' attention, and they classify that as the biggest tail risk for the market. Coming to Chinese economy, well, they are the manufacturing house for the world. There are various categories where they command dominating share of volume. This is possible thanks to relentless execution by China, but some credit should also go for the subsidy provided by Chinese government. While we provide subsidy for food, fertilizer and oil, Chinese government has provided subsidy for setting up factories for absorbing technology. And this gives China global commanding market share across various items from textiles to electric vehicles. China's trade reached record $7 trillion, with exports touching $4 trillion and trade surplus reaching above $1 trillion. While US did put tariff on China, China's exports to Asia, including India, has gone up substantially. Chinese quarterly GDP growth is constantly around 5%. China is also prudent in AI race. They are able to get better output with lesser investment. And one can see the kind of money spent by American hyperscalers vis-a-vis Chinese deep tech companies. Undoubtedly, China faces a challenge on consumption. Their aging population is not consuming as much as they would like. Somewhere the slowing economy is reflected in higher or rising non-performing loans in retail segment, mortgages, consumption loan, credit card, all are seeing upward movement. Foreign investors, despite China's impressive performance on technology, has started taking money out of China, and the overall outflows have increased to 281 billion. Coming to US economy, Jan to March quarter growth came at 1.6%, well above previous quarter at 0.5%. Unemployment remains very low, showing resilience of US economy. Corporate America is doing wonderfully well across Europe, Japan, and emerging markets since 2006. Over 20 years, American companies have produced highest EPS growth. This resulted into American markets touching nearly all-time high and adding close to $10 trillion in terms of wealth to American household. US consumption is also supported by this wealth effect. Many US families are feeling wealthy and spending money. Undoubtedly, apart from consumption, US GDP growth has been supported by AI-related infrastructure spending. While America spends close to $1 trillion on AI investment, a substantial portion of that is through imported equipments. The debt of America continues to expand. It is now close to $39 trillion. Average American today has debt of about $113,000. But if we include only taxpayers, that's about $355,000. US dollar has depreciated against major currencies over last 1.5 years. The US 30-year bond crossed 5% yield after a gap of almost 19 years. Even though President Trump appointed Kevin Warsh as Fed chairman, market now believes that Fed will be raising rates rather than cutting rates. Global investors continue to pump money in American market. They own about 21 trillion of equity, about 19 trillion in foreign direct investment, and about $16 trillion in American debt. About 11 trillion is other assets. Combined US assets owned by non-US entity is roughly about $65 trillion. That's a substantial sum of money. US has been a vacuum machine which has absorbed global liquidity. Coming to Indian economy, undoubtedly we are in for a rough ride. The headline numbers have by and large remained steady. GST collection was up 3.2%. But if you remove the adjustments of the past where there was one-time gain, the collection is about 10% higher. Inflation continues to remain soft and industrial growth continues to remain in mid-single digit. Headlines so far are not reflecting the turmoil expected going forward. Why do we believe we are in a rough weather? Well, oil prices are our nemesis. Higher oil prices impacts current account deficit, rupee, inflation, interest rates, corporate profitability, equity market outflows. Undoubtedly, higher oil prices will impact our macro. Inflation on wholesale price inflation side has crossed 8%. CPI has crossed 3.5%. And RBI has revised its inflation target for rest of FY27. Our trade deficit continues to remain elevated because of higher oil import, and we run one of the largest deficit in the world. Our trade deficit remains structural. As you can see, over last 20 years, except 2021, which was more of a COVID impacted year, we have by and large run large current account deficit. This also ensured that rupee becomes one of the weaker currency. It has depreciated maximum against US dollar. Our fiscal deficit for FY27 will widen. It will be difficult to meet budgeted target as food, fuel, and fertilizer subsidy crosses budgeted estimates. We have seen such kind of crisis in the past. Our playbook remains almost similar. FCNRB bonds, ECB bonds, interest rate tightening, some of the export bans, some of the import duty hikes. This is by and large we have done in the past to overcome crisis, and some of this has already happened in current crisis. Apart from Middle East, our problem remains with monsoon. The IMD revised monsoon forecast from 92% of long-term average to 90%. That's driven by severity of El Nino index, which is becoming adverse to India. Whenever it is red, it is adverse. And also Indian Ocean Dipole Index which has started becoming red again. When El Nino is there and Indian Ocean dipole is positive, it benefits us to negate El Nino's impact. But today we are seeing that El Nino index is increasing and IOD is no longer positive. So undoubtedly we are likely to face a below average monsoon. We have to hope and pray that distribution of monsoon is reasonably good. One safety wall in the dark cloud is the reservoir water level that continues to remain above average. Hopefully, it will secure us in this Kharif season. Some of the silver lining in this turbulent time, the Manrega demand continues to remain soft, which means rural economy is doing well so far. If we look at El Nino impact, undoubtedly it has impact on food inflation as well as food production. We have seen rural economy getting impacted by El Nino, impacting two-wheeler sales as well as Nifty rural index. But everything depends upon how weak or how strong El Nino was and whether Indian Ocean dipole turning positive negated that or not. Our biggest risk came in the FY16 major El Nino. However, in FY24, thanks to positive IOD, we were able to negate impact of strong El Nino in a reasonable fashion. Another silver lining is India's power management. Undoubtedly, we have seen some power cuts even in the city of Mumbai, but that's more because of infrastructure breaking rather than non-availability of power. Our power demand is near all-time high level, and yet by and large grid is working satisfactorily. The other positive change is on employment. Now manufacturing is witnessing positive growth in employment, whereas agriculture is seeing exodus. At this point of time, India employs more people in manufacturing than construction. Make in India is finally seems to be moving people from agriculture to manufacturing. The third challenge for India remains artificial intelligence. There are different layers of AI in terms of hardware like chips or GPUs or LLMs or cloud infrastructure or software. In all this segment, sadly, India is missing. It has started entering the race far, far behind. For example, in making chips, for example, in developing LLM, in building data centers. But undoubtedly, China and America are far ahead of us. Today, while we have started taking baby steps in semiconductor chips, models, and application, we remain far behind leaders like US and China. Obviously, this is function of least amount of investment we are doing in research and development. Compared to Korea, we are almost 1/10. And this severely impacts our ability to be at the cutting edge of technology. The question which people are asking after 20% correction in artificial intelligence related sector, Is AI a bubble? We don't know the answer. Very rarely, a concentrated number of stocks have moved global market. We are today witnessing that phenomena. Top 100 stocks have delivered bulk of the return in top 10,000 stocks across the globe. 100 stocks delivered 34% return and 9,900 stocks delivered 0.6%. See the massive outperformance. No price for guessing that this top 100 stocks belong to artificial intelligence and technology related sector. AI related sectors now contribute more than half of S&P 500. Magnificent Seven have delivered bulk of the return vis-a-vis S&P 500. Even emerging market without stocks like TSMC, Samsung, and SK Hynix will underperform American market. This AI stock rally is driven by profit growth. The gray bar represents PE re-rating and the red bar represents profitability. As you can see, AI companies are generating massive amount of profit. Consumers of AI like hyperscalers which make investment in data centers and GPUs, they seem to be delivering lower return or negative return at today's pricing. If all these companies continue to maintain their pricing for the AI services, then most of them are likely to incur losses on the all investments they have made. The Capex estimate, despite those challenges, continue to remain high. From $800 billion to invest now, they are committed to invest almost $900 billion. Earlier, AI investment was funded out of profits and net worth. Now it is funded out of borrowing. We saw Google coming to borrow $80 billion in the capital market recently. If we look at NASDAQ of TMT era, it moved up 3 times and then corrected massively. If I look at KOSPI, it's up 3 times in last almost 18 months. Today it corrected about 5%. Will KOSPI mimic NASDAQ? And if yes, will the other AI stocks also mimic similar behavior? If we compare price movement of various manias like US Railroad, like utilities, telco and industrials before Great Depression, even US had Nifty 50 companies, a Nifty 50 index to account for their majority companies, or Japan, or telecom media technology bubble, or artificial intelligence. They all have seen peak around current levels of growing about 40%. Will we see this moving down? Well, it has already come down by some percentages in last 1 month. AI investment as a percentage of GDP is well below historical bubbles. Does that mean that AI investment can continue for some more time? Who knows? Normally, bubbles get busted when interest rate starts moving up. From 1990 almost to 2021, US interest rates kept on declining, albeit there were few periods of a slight upward movement, but undoubtedly direction was on the lower side. Interest rates have bottomed out and they have started inching further up. Will this peak AI bubble? Time will tell. Second, we have seen IPOs coming and making the top of the market. Morgan Stanley Growth Fund made top of 1990s market. We have seen QIPs of TMT companies coming, K10 kind of index coming and making top of 2000 TMT bubble. 2008, we saw power company large IPO making top. Recently, we see one of the fintech coming with a large IPO and making the top of the market. Same thing is happening in America with IPOs of OpenAI, Anthropic, SpaceX, and many others. Between rising rates and increasing supply, will we see markets correcting? Let's wait and watch. In this scenario, coming to equity market, small and mid cap have bounced back. There is a bull run going on in micro cap with stocks jumping up 15 to 20% from bottom. Valuation wise, markets looks fair around their historical averages. Nifty is at about 19 times historical average. Currently, it is little below historical average. Small cap averaged about 17 times. Today, it is at a slight premium at 22 times. Mid cap was averaging 24. Currently, it is at 28. There is a tussle going on between DII and FPI. FPIs are on the selling side. DIIs, thanks to all of your support, is on the buying side. FPIs are selling mainly in financials, IT, energy, FMCG, companies where valuations were high, expectations were high, and delivery didn't come through. However, there have been buyers in telecom, industrials, and metals where numbers were coming ahead of expectation. FPIs redeemed because Indian market underperformed all other emerging markets from Korea to Mexico to Brazil to Taiwan to China. This selling by FPIs have brought them to a decadal low holding of about around little under 15%. Our weight in MSCI emerging market is now below China, below South Korea, and below Taiwan. There was a time when between China and India, 50% of MSCI emerging market weight was accounted for. Now it has become under 1/4. This correction has also ensured that our markets as a percentage of global market is around our historical average. The quarterly results are coming well ahead of expectation. Nifty 50 companies' profits were expected to grow at 2%. Actual came at 4%. Large cap was expected to grow at 5%. Actual came at 12%. Mid cap was bumper against 25% YOY growth. Actual results came at 36%. Small cap by and large was in line with the expectation. Undoubtedly, large and mid cap delivered above expected results. Promoters seems to have started buying with this correction. The promoter holding after declining since 2024 have started improving. Experience suggests that after rupee weakness, when Indian market has become attractive, it does result into FPI buying into India growth story. Let's hope and pray this time it is not different. Our outlook remains overweight mid-cap marginally, equal weight large cap, underweight small cap, and keep neutral allocation to equities. In terms of equity opportunity, this is our rolling return average for our equity funds and hybrid funds. By and large, we have delivered better return than our benchmark index. This is point-to-point return where both small and mid-cap funds have failed to outperform benchmark index. Small cap underperformance is sharp, mid-cap underperformance is manageable. Even in other equity and hybrid funds, by and large, we have been able to add value to the customer. This is the SIP return. Again, across majority of period, we have delivered SIP return. While 3-year return for SIP has moderated significantly, small cap SIP is about 6%. Benchmark would have delivered about 8%. Contra is at about 9%. Large cap is at about 5%. Large and mid cap is at about 8%. But mid caps and focused have delivered double-digit return. The limited point is, while 2 years SIP returns may look bad, 3-year SIP returns, 5-year SIP returns still looks quite reasonable. Are some of the funds which have stood test of time. One is Kotak Flexi Cap Fund. Harsha has managed this fund with discipline and it has delivered consistent return, as can be seen in this slide. Kotak Multi-Cap Fund across large, mid and small is managing allocation, again generating significant alpha, not only in lump sum, but also in SIP. Kotak Multi-Asset Allocation Fund has been Harfan Maula Fund. It took brave call on both gold and silver, and that has resulted into significant outperformance over benchmark index since inception. Between multi-asset allocation fund, multi-cap fund, and flexi-cap fund, you have 3 of our most appropriate fund in today's environment. Even the SIP returns across multi-asset allocation fund has been fairly positive. As can be seen, the alpha generation in our multi-asset allocation fund has been positive, consistent, and what we have told our customers through you is balanced asset allocation, and this is what we have proven over last decade. 17% return, 5% alpha over Nifty 50 is truly commendable. Small cap fund, as I mentioned, our performance is right at the bottom. There are constraints which are beyond us. One was inability to invest in multi-commodity exchange, MCX. This has delivered absolutely stunning return. Unfortunately, as Kotak Bank holds 15% in MCX, Kotak Mutual Fund cannot invest in MCX. Trouble comes in battalion. There were 5 banks where we could not invest across Kotak Mutual Fund for regulatory permission. Now, both these constraints are behind us. We have got permission from RBI to increase our stake beyond 5% in these 5 banks. and we shall utilize it over next 1 year. On MCX, a Via Media has been found with the blessings of our legal counsel. Put together, our constraints have gone, and hopefully we'll be able to do justice to our investors' confidence in small cap fund. We are also launching our SIF Special Investment Fund. As you know, hybrid long short fund falls between arbitrage fund and conservative hybrid fund in terms of risk return profile. It will have lower volatility than hybrid funds and higher volatility than liquid and arbitrage fund. How does hybrid SIF differ from comparable funds? Do go through this chart. It has certain taxation advantages. It has certain flexibility in shorting up to 25% of assets, and it can give uncorrelated return to market movement. This hybrid SIF long short also differs vis-a-vis other hybrid funds in our category, be it balanced fund, be it balance advantage fund, or be it conservative hybrid category. The asset allocation of SIF will remain between equity for arbitrage and naked position, between debt from an accrual point of view. In special situations like buyback or IPO or open offers or blocks at discount or mergers and demergers. These are absolute return strategies. The derivative will use covered call, shorting of index and securities at opportune time, using option strategies like straddle and strangle, doing pair trade, or doing calendar spread. We will also be investing in REIT and InvIT. Put together, this hybrid SIF will focus on generating annual return with lower volatility. Obviously, to manage these strategies, one requires talent. We recruited Kalpesh from another mutual fund where he has managed such strategy for a long period of time. With his expertise in our risk management, we believe we'll be able to do justice to our investors' confidence. This fund is opening for subscription on 15th of June. These are some of the drivers and trend which we will capture in our investment approach. How does this fund perform over various cycles? Undoubtedly, while the focus is to generate absolute return irrespective of ups and downs of the market, there will be periods where this fund may not match absolute return targets. We have backtested our strategy in research laboratory. Whatever works, we have to ensure that it works in real life. But at least you could be assured that we are testing a model in our research laboratory before we bring it out in open. This is the most important slide for SIF. It shows how over a period of time this fund has generated absolute return over 6 months period. On a 1 month, 3 month basis, there are times when fund has delivered negative return, but on a 6 months, 1 year, 2 year basis, by and large, this fund has generated absolute return. Coming to fixed income market, Credit and deposit growth is in double digit. CD ratio remains elevated. RBI has managed liquidity through intervention, but 10-year yield has gone up from 6.15 to almost 7% through relentless pressure on the currency. The market is worried that RBI may use interest rate policy to defend rupee. Fortunately, RBI has chosen other options like ECB issuances, FCNRB issuances to raise foreign exchange reserve rather than raise interest rates in the local market to attract foreign capital. In the debt market, we believe income plus arbitrage fund continues to remain attractive. It carries tax rate of 12.5% post 24 months, and one should look to invest from a carry as well as lower taxation point of view in income plus arbitrage fund of fund. Gold and silver have gone through a lot of volatility. We remain bullish gold since March 2020 when our asset allocation fund started investing in gold. In silver, we have started investing since April 2025. Normally in the war time, gold prices should go up. This time, gold prices have corrected. This is driven in rupee terms, gold prices haven't corrected as much because about 9% import duty was increased from 6 to 15 in the month of May 26. Overall, gold demand continues to remain healthy at about 1,000 tons a quarter. This is driven by central banks buying of about 250 tons. Jewelry is about 300, 400 tons. Investment is roughly about 500 tons. This is driven by both ETF as well as physical demand for gold and silver. Put together, we remain positive on gold as long as central bank continues to buy gold. Our gold call is essentially a front-running call on central bank. If they buy, we buy. If they sell, we sell. Undoubtedly, gold prices do get impacted by rising yield. They behave inversely. When US interest rates started going up, gold prices have started coming down. The current derivative position on US market suggests slightly bearish outlook on gold. The investment demand have also started slowing down, and like India, investors have started redeeming money out of gold ETF. The gold is hedged by China's vociferous appetite. Their month-on-month increase in gold import in April is about 80% higher over March. Silver prices have continued to remain volatile. It's now firmly in double digits compared to triple digit price seen just at the beginning of the year. Our outlook on gold continues to remain positive, but expecting higher volatility and also lower return. If I have to summarize, do look at 4 products in your portfolio, in your client's portfolio. One is SIF, where returns will be lower than pure equity, but volatility also will be correspondingly lower. SIF does long short as well as leverage. It's available in hybrid and equity category, and it requires special skill and talent to manage SIF. It's not everybody's cup of tea. You can start small and build on experience. Do participate in Kotak Infinity Hybrid SIF NFO opening on 15th of June. See how we perform, and then you can put bigger money. Performing Credit AIF is a close-ended fund, but there are regular cash flows in between. It's both debt-oriented and equity-oriented. Debt-oriented are less risky and lower return. Equity-oriented one is higher risk and higher return. There is regulatory arbitrage for the performing credit AIF due to restriction on other financials like banks, mutual fund, pension, and insurance company. Do consider REIT and InvIT as a convenient way to take exposure of real estate in your portfolio. Over next 6-12 months, interest rates will rise. This will adversely impact REIT and InvIT prices. Hopefully, you will get good opportunity to buy REIT InvIT over next 6-12 months. Global funds, while our limits are full for accepting subscription, there may be competitor whose funds will be open, or else you can consider Gift City Fund for diversification point of view, geography, business, as well as valuation diversification. One final thing is take advantage of LRS. If you sell gold in India, you get about 18.45% higher price than global price because of 15% import duty and 3.45% GST. You can sell gold here, take that money via LRS into global market, and you will be able to invest in gold ETF or physical gold as per your convenience. You'll be able to get 18.45% higher gold compared to local market. This is our asset allocation view. Neutral weight equity, overweight gold, trading in silver, sectorally bullish financial services, consumption in e-commerce and healthcare, sectorally auto, healthcare, cement, financial services, infrastructure looks good. Funds which you can look at across our portfolio, multi-asset allocation, multi-cap and flexi-cap. Our passive portfolios continue to expand, and you can consider passive funds as appropriate for your client's portfolio. We continue to write weekly blogs and also do audio podcast of the same in English and Hindi. They are getting rave reviews from professionals, industry associations, and corporate. Do read that or listen to that for enhancing your knowledge. Sector communication also comes from our analyst and fund managers, again getting rave reviews from investor community. I don't know how many of you have seen our consumption report. It got discussed even at the highest level in terms of data. We continue to communicate with you with timely update of events. Do use Business Hub to get information which you will require. The Great Consumption Shift is a must-read report. One snippet from there. Indians have lost 280,000 crore in last 3 years for trading in FNO. That is substantially more than what Indians spend on many items from footwear to ready-made garments. If we can guide these people away from speculation where they keep on losing money to SIP, mutual fund, it will be good for them. We also conducted our UNI event for distributors to educate them. Do check about the same with your sales RM. With this,